Chapter 7, Analyzing Common Stock. Chapter 7 focuses on stock analysis, looking at economic, industry, and fundamental analysis techniques, and this chapter has a lot of accounting review in it. We're focusing on the analysis part of looking at investments, not the valuation. Valuation is Chapter 8. This is the background analysis. The analysis part involves information gathering and organization in order to make educated investment decisions. The end game: what is the true or intrinsic value of a share of stock versus its market price? Clearly, no rational investor would buy an overpriced stock. In 331, we've already covered how to value a share of stock based on its future expected cash flows and the appropriate discount rate. This chapter is looking more at fundamental analysis. Taking a top-down approach to security analysis involves looking first at the overall economy, the general state, and the direction. Step 2 is industry analysis, the outlook and competitive situation in an industry. And finally, we look at specific stocks within an industry, their performance and expectations for the future. Who needs security analysts in an efficient market? So why do it? Because some stocks may, at a point in time, be mispriced, offering the opportunity for above-average gains. You might be able to identify one of those mispriced stocks. Assuming that the efficient market hypothesis is true, then why do we need security analysis, or analysts for that matter? The EMH says that securities are rarely mispriced, so there's no way to consistently beat the market. But the reason that markets are efficient is because of all the people doing security analysis. Still, mispricing can occur. Starting at the top of the top down, we'll look at the overall economy. Where is it headed, up or down? What key economic factors serve as benchmarks? This graph shows the performance of the stock market from January 1969 to January 2013. Clearly an upward trend with a couple of dips along the way. The overall economic climate has a strong impact on the performance of most companies and therefore on the securities markets. The economy typically goes through business cycles of expansion and contraction over time. Two of the most widely watched metrics are the gross domestic product, GDP, which measures, as the slide says, the market for all goods and services produced in a country. This is probably the number one indicator of a country's strength and growth potential. Industrial production indicates the output of a country and typically moves with the GDP. This slide lists just a few of the main factors affecting the state of the economy. No surprise, government fiscal policy is high on the list, as it drives so much in terms of government spending and taxation. Monetary policy, think back to your econ class, how the Fed controls the money supply to encourage or inhibit growth and inflation. Needless to say, inflation in consumer spending and business investments have a strong impact and are driven significantly by confidence in the economy. This table lists some of the major economic indicators with GDP and the industrial production numbers at the top. Also on the list, personal income, retail sales, the money supply, consumer and producer prices, employment and housing starts, all of which give an indication of the future growth in the economy. Probably the most widely read source of both economic and market news is the Wall Street Journal. For more focused coverage, Barron's and Bloomberg's Business Week. Brokerage firms publish periodic reports on the economy, industries, and specific stocks, but these are usually only available to their clients. So how do you use overall economic information? Consider what it forecasts for the future. What industries will be affected, positively or negatively? Where should your investment focus be for the near term? Table 7.2 in your text and on the next slide gives some pointers on how to use broad economic indicators to predict how stock prices may react. GDP, industrial growth, corporate profits, and the federal budget tend to have positive effects. A weak dollar and the money supply can have mixed results, while inflation, unemployment, and interest rates tend to have a negative impact. The market itself is a leading indicator. Leading means changes happen in the indicator before they actually begin to appear in the overall economy. So watching the market is a predictor of the future economy. Once the direction of the overall economy has been considered, the focus turns to specific industries. In analyzing an industry, we want to look at such things as what key economic variables drive performance and success in different industries, and how does that look for the future? Right on the slide, step 1. What's the competitive position of the industry overall? Warren Buffett has said, paraphrasing, that if you're in a business where you cannot raise prices by 10% without a prayer session, you're in the wrong business. Something to consider. If the competitive environment is that strong, it can be a problem. Step 2. Which companies in an industry show particular promise? Strong market position, good growth potential. So what are you looking for when you're evaluating an industry? How regulated is it? Are there labor issues? How is it impacted by technology, and how is it reacting to it? What economic forces are important to success in that industry? Basically, overall, what is important to success? Industries overall and companies tend to move through growth cycles. Initial development. This is a new industry, very risky. Assuming success during initial development, the next stage is rapid expansion to meet market demands. Investors at this stage can share in that rapid growth of the industry. Given survivorship bias, those that do survive the rapid growth stage tend to mature, and they begin to move with the market, which moves with the economy. Growth is slower, more measured. The final stage is called stability or decline. At some point, an entire industry can fall out of favor or be replaced by newer options so that demand falls and firms begin to drop out. Identifying where an industry is in this cycle is important to deciding if it's a viable investment target. Industry information is more focused and available from the sources cited on the slide. Once you've drilled down on an industry and decided it looks positive, now's the time to identify which firms in this industry stand out as excellent investment opportunities. Fundamental analysis focuses on a specific company within an industry, one you've ID'd as a potential investment. The rest of this chapter is basically an accounting review in terms of using financial statements to analyze a firm, and it should be a review for most of you. Using publicly available financial data on a firm, the goal is to evaluate the strength of the firm. What assets does it own and their composition? How is the firm financed? What's the profit margin? This is time-consuming, and many rely on published reports to boil down to the critical factors. Still, it's important to understand what those published reports are telling you and what they're using as the basis for their conclusions. One of the 4 financial statements required in a publicly traded firm's annual report is the balance sheet. You're all familiar with a basic balance sheet. Assets in order of liquidity, liabilities in the order of how quickly they must be paid, and stockholders' equity, assets minus liabilities. It's a balance sheet. Total assets must equal the total of liabilities and stockholders' equity. Here's a sample balance sheet for Universal Office Furnishings. Note that a balance sheet is as of a specific date, in this case December 31st, 2016, with data for both 2015 and 16. Assets on top, followed by liabilities and stockholders' equity. The income statement provides operating results over a specified period. Could be an accounting period, a quarter, a year. It starts with sales or revenue and subtracts operating expenses, interest, and taxes to arrive at the bottom line, net income. Here's Universal's income statement for the years ending December 31st, 2015 and 2016. Important items. Sales grew year to year, but net profit declined slightly over the same period. The company did, however, increase their dividend per share by 2 cents, and earnings per share increased. We discussed the statement of cash flows in 331. It's the one financial statement that reconciles the income statement and balance sheet, accounting statements, with cash, the focus in finance. We're concerned with cash, but accounting statements employ non-cash items, depreciation, and accruals. It is possible to manipulate earnings, but not cash. The statement of cash flow has 3 sections: cash flow from operations, cash flow from investing, cash flow from financing. The bottom line reconciles cash on the balance sheet at the beginning of the year with cash at the end of the year. And here is Universal's statement of cash flows for 2015 and 16. When analyzing a firm, look at the net cash flow from operating activities in particular. This should be positive. A firm should make money at their basic business, whatever that is. Given these basic financial statements, looking at financial ratios derived from this data can give an investor a clearer picture of whether the firm is moving in the right direction or not. We studied these in 331 as well. Ratios allow comparison year to year against competitors, against peers, against aspirant firms, as well as versus industry averages. This provides a more focused picture of trends and performance than absolute numbers can. We're going to look at the same 5 groups of ratios that we covered in 331: liquidity, activity, leverage, profitability, and market measures. Liquidity ratios measure a firm's ability to meet its current expenses. The current ratio is one of the few measures that has an absolute benchmark. It should be greater than 1, but not too large, since that would imply assets not employed in generating income. Current ratio is current assets divided by current liabilities. For Universal, that's 1.34. The quick ratio refines the current ratio by removing inventory, which is frequently not very liquid. Quick ratio is current assets minus inventory, quantity divided by current liabilities. For Universal, that's 1.06, also above 1 and a good result. Net working capital is defined on the slide as the dollar amount of equity in the working capital of the firm. Note, this is not the net operating working capital of 331. This is straightforward net working capital, current assets minus current liabilities. If the current ratio is greater than 1, then net working capital is going to be greater than 0. Again, an excess amount is not desirable. Activity ratios measure how the firm is performing in using assets to generate sales, which is the point. In general, higher is better. Accounts receivable turnover measures the relationship between sales and accounts receivable, credit sales. A high number is better. We're probably more familiar with days sales outstanding, which measures how long dollars stay in accounts receivable before being converted to cash. For Universal, given the numbers on the slide, day sales outstanding is 42.8, a bit longer than probably optimal. Inventory turnover measures how many times during the year a firm completely sells out its inventory. Higher is better. Inventory turnover is simply sales divided by inventory, though some analysts prefer to use cost of goods sold in the numerator. Universal's number, 18.69, looks good, but this is a metric that needs to be compared to something. Last year, industry, peers, to have any real meaning. Total asset turnover indicates how well a firm is using its total assets to generate sales. Again, higher is better. Total asset turnover is simply sales divided by total assets. For Universal, 2.06 needs to be compared to something for reference. Leverage ratios are also known as solvency ratios. They measure how well a firm is using debt in its capital structure. From an investor perspective, the concern is the amount of debt overall and the firm's ability to service that debt. Debt to equity is not percent of debt. Debt to equity is long-term debt divided by stockholders' equity, numbers that come right off the balance sheet. Again, note, it is long-term debt divided by equity. This allows you to assess a stock's risk exposure, because remember, when a company takes on more debt, the risk is focused on the stockholders. If the debt to equity for Universal, which is shown as 0.60, then debt is equal to 0.6 equity. So total assets is equal to 1.6 equity. Percent of debt, 0.6 equity divided by 1.6 equity, or 37.5%. The equity multiplier should be familiar from its use in the DuPont identity. The equity multiplier is another measure of a firm's use of debt. It's equal to total assets divided by stockholders' equity. Times interest earned measures a firm's ability to service its debt. Higher is better. 8 to 9 is strong. Universal 17.55 is very good. This is also known as a coverage ratio. Profitability ratios clearly measure if a firm's making a profit and how much. Higher is better. The 3 primary ones are net profit margin, ROA, and ROE. Net profit margin is just the bottom line as a percent of sales. Higher is better. Universal 7.2% is a good number, but as with many ratios, comparison with past years, peers, and industry numbers are needed to determine if it's performing as well as it should. Return on assets measures how well management is using its total assets to generate profit. Again, higher is better. Net profit divided by total assets. Return on equity is a measure many investors watch since it measures how much the firm is earning for its common shareholders. This is also known as return on investment. Higher is better, and an upward trend is even better. Breaking down ROA and ROE. As you may recall from 331 and the coverage of the DuPont identity, ROA is equal to profit margin times total asset turnover, the same result we found 2 slides back. Continuing with the DuPont identity, ROA is equal to profit margin times total asset turnover, so ROE is ROA times the equity multiplier. It's just an extension. Using the ROE equation from the previous slide, you've got the DuPont identity. Using this configuration allows analysis of why ROE is moving up or down. Which component, profit, asset utilization, or debt utilization, is the cause. A high ROE is a good thing for the firm. The final category of ratios are market ratios, termed here common stock ratios. Earnings per share is equal to net income minus preferred dividends quantity divided by number of shares. Be wary of this one. In 331, we never dealt with preferred dividends, and they do have to be subtracted from net profit. We're concerned with earnings to common shareholders only. P/E ratio indicates how much investors are willing to pay for $1 of earnings. It's simply price per share divided by earnings per share. For Universal, investors are willing to pay over $18 for $1 of earnings. Higher P/E ratios indicate the expectation of future growth. The PEG is the price-earnings growth ratio. It's the P/E ratio divided by a 3 to 5 year earnings growth rate. You can see how it's interpreted. Greater than 1, the stock is either fully or overvalued. Equal to 1, fairly valued. Less than 1, stock may be undervalued. Dividends per share. Pretty obviously, common dividends per share of common stock. Investors expect this to increase year to year. For Universal, 15 cents a share is not a very high dividend. A stock's payout ratio is what percentage of the firm's earnings are paid out as dividends. Dividends per share divided by earnings per share. Payout ratios have typically been in the 30 to 50% range, but nowadays fewer companies are paying dividends than did many years ago. Growth firms typically pay out nothing, choosing to reinvest earnings for more growth. Investors do not like a declining payout ratio or any cut in dividends. Universal is only paying out 7% of their earnings, and that's a pretty low number. Book value per share is an accounting number that measures the value of the firm as total assets minus total liabilities, or total equity. So book value per share is the quantity total assets minus total liabilities divided by number of shares. Market price per share should be greater than book value per share. Price to book compares market price per share to book value per share, which should be greater than 1. If it's not, it's an indication that investors do not think management is doing a good job using the firm's assets to generate profit. As the slide says, most investors rely on published reports and publicly available data, but you've got to understand what's in these numbers to be able to evaluate what they mean. This is probably hard to see on the slide, but it's also in the text. It's figure 7.2. The data is for Apple from May 17, 2015 from Mergent Online. The first data set includes Apple's financial statements, their income statement, balance sheet, cash flow statement. Below that is the stock price and valuation data, including market capitalization, shares outstanding, dividends per share, and price history. The right-hand side covers selected ratios, management effectiveness, profitability, valuation, asset management, debt management, and liquidity measures. So with all this data, how do you use it? Look at the firm's historical trends. Compare a firm to industry averages, remembering that those averages, that's the C grade for the firms in that industry. How does your target firm look compared to others in the industry? Look at the competition. Look at peers. Look at your major competitors. Compare to a firm that you aspire to be. This is table 7.6 in your text. And this recaps Universal Office's ratios for 2013, 14, 15, and 16 versus industry averages. Liquidity measures are good, below the industry average though. Universal's activity ratios are vastly better than average, as are their leverage and profitability measures. Their P/E and price to book are above the average, but their dividend yield and payout ratio are well below average. Continuing the comparison with Universal's peers and competitors, this is table 7.7. Universal's net profit margin is in the same range, but above the others. Their debt-to-equity ratio is above the others, but their TIE coverage is also well above it. ROA, ROE, and PE are all above the others, as is their price to book. Overall, Universal looks to be in good shape financially. That ends Chapter 7.